That 8% yield you are counting on for retirement is not the number you think it is. It is not a reward for patience. It is not evidence that you found the right position. It is a number that exists because the market has already done the math you have not done yet. And the answer the market arrived at is a share price low enough that a payment the company has not cut yet represents 8% of what the stock currently costs. The payment has not been cut. The price has already moved to reflect the probability that it will be. And the retirement portfolio built around that 8% is not built around income. It is built around a story the payout ratio is still telling, while the free cash flow statement tells a completely different one. The post-2025 interest rate pivot created a specific and predictable psychological trap for retirement investors. And understanding the trap requires understanding why the pivot made it worse rather than better. When rates were rising through 2022 and 2023, income investors faced a straightforward problem. The fixed income alternatives that the rate environment was creating, treasury bills yielding 4 and 5%, money market funds offering rates that had not been available in 15 years, were pulling capital away from dividend equity because the risk-adjusted case for equity income was deteriorating. Retirement investors who needed income had a choice that had not existed for a decade. Most of them stayed in their dividend positions because the yields were higher, the history was longer, and the familiarity was more comfortable than relearning fixed income markets they had not needed for 15 years. Then the pivot began. And here is where the trap closed. As rates began to shift directionally in 2026, retirement investors who had endured the rate hiking cycle with their high-yield equity positions intact made a specific and understandable error. They interpreted their survival of the rate-rising cycle as validation that the positions were sound. The dividend had kept arriving. The positions were still there. The strategy had weathered something that most financial commentary suggested would be damaging to yield-oriented equity, and the positions were still standing. That survival felt like proof. What it was actually was a delay. The rate environment had been pressuring the underlying businesses for 18 months. The free cash flow deterioration was visible in the financial statements for anyone who checked, and the dividend cut had not yet arrived because boards had been funding the payment through mechanisms that were not operational cash flow and that had a finite runway. Traditional dividend benchmarks of 5 to 7% are failing to keep pace with current core inflation, not because the businesses behind them are uniformly poor. Some of them are genuinely strong, but because the category was selected on yield rather than on the quality of the cash flow generating the yield. And in an inflationary environment where the real purchasing power of a fixed income stream declines at the rate of inflation, regardless of whether the nominal payment continues arriving, a 5% yield against 4.5% inflation is generating 18 basis points of real return before taxes. A 7% yield against 4.5% inflation in a 22% tax bracket is generating approximately 1% of real after-tax return. A retirement portfolio built around a yield target without a real return calculation is a portfolio that is losing purchasing power, while the nominal income creates the illusion of financial stability. The debt-to-equity imbalance is the structural signal that most retirement investors are not checking on their high-yield positions. And it is the signal that predicts the dividend cut before the payout ratio shows it. Here is the specific mechanism. A company carrying significant debt at rates issued during the low-rate era faces a refinancing event when that debt matures. The old debt at 2 or 3% rolls into new debt at 6 or 7%. The interest expense on the income statement increases by the full differential on the outstanding balance. That increase flows directly through to the earnings figure that the payout ratio is calculated against. And the payout ratio that looked sustainable at the old interest expense level becomes unsustainable at the new one without any change in the company's operating performance at all. The business did not get worse. The capital structure became incompatible with the dividend commitment at the new rate environment. And the board that has been maintaining the payment through the transition period faces a choice between a dividend cut and continued debt-funded payments that cannot continue indefinitely. The payout ratio does not show this deterioration until after the refinancing has occurred and the new interest expense is flowing through the income statement. A position showing an 80% payout ratio against trailing 12-month earnings is not showing the payout ratio against the earnings that will be available after the debt refinancing. that is scheduled for the next 2 quarters. That forward payout ratio, the one calculated against the earnings figure that actually reflects the company's capital structure in the current rate environment, is the number that predicts whether the dividend survives. And most retirement investors are looking at the trailing number, treating it as current, and making decisions about a payment that will be determined by a forward number they have not calculated. The psychological dimension of this trap is the most expensive part. Not because psychology is more important than numbers, but because psychology is what prevents the numbers from being checked. The retirement investor who has built their monthly income plan around a specific dividend amount has a powerful incentive not to look too closely at the free cash flow statement. The number they need to be true is the number they are checking against. When the check confirms the payment is still arriving, the tendency is to stop the analysis at the confirmation, rather than continue to the question of how long the payment can continue arriving under current conditions. This is not irrationality. It is the entirely human response to needing something to be true, while holding the power to not look at evidence that might prove otherwise. But in retirement portfolio management, the cost of that psychological protection is measured in the gap between what the portfolio was supposed to do and what it actually does when the dividend cut arrives and the share price reprices simultaneously to reflect the cut and the business deterioration. The stress test for a high-yield retirement position is 3 questions asked simultaneously rather than sequentially. The first is whether the free cash flow after capital expenditure requirements, not earnings, not EBITDA, actual free cash flow after CapEx, is covering the annual dividend obligation at a ratio above 1.2 times and whether that ratio has been stable or improving over the past 6 quarters. If the free cash flow coverage is below 1.2 times or has been declining for multiple quarters, the dividend is approaching unsustainability regardless of what the reported earnings look like. The second is whether the company faces significant debt maturities in the next 24 months and what the interest expense differential implies for the forward payout ratio. A company refinancing $2 billion from 3% to 7% is adding $80 million in annual interest expense to its cost structure. That $80 million comes directly from the cash available to fund the dividend. The third is whether the share price decline that produced the elevated yield was driven by sector-level sentiment or by business-specific deterioration, because the implications for the dividend's durability are completely different depending on which is true. A position that passes all 3 tests, genuine free cash flow coverage, no near-term refinancing cliff, price decline driven by sentiment, is not a yield trap. It is a mispriced income opportunity. These positions exist. They are identifiable through the same diagnostic process that exposes the traps. The difference is not intuition, and it is not familiarity with the company name. It is the specific numbers behind 3 specific questions that take less than 30 minutes to check, and that completely determine whether the income stream will still be arriving in 3 years. The retirement portfolio that survives 2026 and the years that follow is not the one with the highest current yield. It is the one whose income stream is still intact. After the rate environment has finished repricing the debt structures of every business that took on cheap capital during the low-rate era and is now facing the bill, the yield that survives is the one backed by free cash flow that is actually sufficient to fund it, by a balance sheet that does not face a refinancing cliff, and by a business whose share price decline reflected sentiment. Finding that yield requires doing the work the yield percentage alone does not do. And in a retirement portfolio, doing the work is not optional. It is the entire difference. It is the difference between the income arriving and the board issuing the press release. Nobody wants to read on the morning, it all becomes visible at once.